A very good evening to all of you, and welcome to another edition of WealthWise with Edelweiss, our webinar series on personal finance with industry experts. Guys, due to some technical issues, one of our speaker has not been able to join, but we are trying our best so that he joins in later. Today with us, we have our market veteran, Aditya Narain, Head of Research, Institutional Equities, and I welcome you. I'm sure that the audience will benefit from your experience and insight. The topic for today is Socialization Impact and Outlook on the Economy, Crude and Markets. Please note there might be some time lag of 10 to 15 seconds due to connectivity or network issue. Kindly bear with us on the same. Over to you, Aditya.
Thank you, Tanya, and good afternoon, everyone. And thank you for taking the time out to join us for this webinar. As I see it, there's a lot of information floating around. There are a lot of views that a lot of us both imbibe from the outside and think up ourselves also. So in many ways, even as this is a massive challenge, it's unprecedented in its scope and scale. The reality is everyone has a lot of knowledge about what's tending to happen, right? So instead of me trying to give too much of a commentary or too many views on data, what I will try and do is really pick up 6 or 7 issues that I think are relevant, that I think people should think about. And there are issues that I think will make a difference in terms of how markets move a little bit from a short-term perspective, but potentially also from a long-term perspective. I think what is also very, very important also is that there is no given in an environment like this, right? How things pan out, there is going to be a lot of estimation, there's going to be a lot of thinking, and quite honestly, there's going to be a lot of guesswork that happens along the way for everyone, for professionals like me, for a lot of professional investors like you on the other side, and for generally people who follow both the markets and what's actually happening. So the first thing that I really want to touch on is the nature of this crisis and why it's a little different. And I'll keep it very, very simplistic. Almost all crises that we actually talk about or compare are have basically been financial crises, which have become economic crisis, and then at a latter stage have ended up becoming human crisis also because of the impact that they've actually had, right? So the order of a lot of such events that have happened in the past have predominantly been financial, followed by the resultant economic problem, followed by the resultant human problem. I think this one is very different, not just in terms of its scale, but in the order that it follows, which is it is first and foremost a human problem, right? And at this point in time, it is impacting almost everyone on the earth, right? This has translated into an economic problem, right? With all the lockouts that you've had, all the dislocations that you've had, economies have been impacted. And it is finally playing through to the financial markets, right? So in order, actually the financial market is basically a derivative reflection of what has happened rather than it being the source of the problem, right? So if you were to take this scenario, basically what it tells you is that this crisis is what we did in a report called the HEF crisis, the HEF, the human, economic and financial crisis, and in that order. And so the magnitude and the implications of this could well be very different from what you've seen in the past. So I think that's a starting point, that please do not necessarily correlate it with every crisis that has happened in the past, where someone says, the market went to this level and that is the support level and so it will always come back, or that there is growth beyond and so it will always come back. I think this one is different. So not that the basic rules of economies don't apply, but the reality is how you come out of those can be very, very different because of the implications that it's had. The second one is that, okay, so if this is going to be very different from anything we've seen in the past, is there anything comparable, or is there some kind of a benchmark that we might set up to actually look at it in terms of how we could evaluate how markets, how economies, and how political systems actually emerge from this, right? So to some extent, the only one which is current and which has been sizable has been the global financial crisis, which a lot of you would have, experienced in some form or the other, even though it was much more distant than this one is, right? And so we've really done a little bit of a playbook in terms of how markets played through when this problem happened, right? And I think when we look back and we did a lot of work, and as someone who's been in the markets for a fairly long time, one was clearly very embedded in the problem that was happening. That when it was happening, in fact, it's so interesting that when it was actually breaking, I was at an India event in New York, and you could actually sense that there is a big problem building up because the streets were thinning out. The financial conferences that we were at, people are all worried and scurrying around, right? So even though one felt it, and at that point in time, the scale of this one has been entirely different. But let's go back to what happened in that, right? When you were in the thick of it, there was a lot of dramatic market movements. There were all kinds of concerns. Lehman went under. There was a lot of panic as far as India was concerned. All kinds of markets, all kind of government reaction, right? And obviously stocks moved up and down very, very dramatically, right? But if you step back and have a look, there were, actually three very clear stages that actually played through for the market, right? The first one was a period of about 2 to 3 months, which is what we call the capitulation stage, where you basically had markets come apart, stocks fell very quickly, and then to some extent they bounced around a little bit, right? This was a 2 to 3 month phase, which we would call the capitulation phase, the capitulation stage, when markets capitulate, confidence capitulates, and the government starts really worrying and starting to react, right? This lasted 2 to 3 months. The next stage, which lasted between 3 to 6 months, depending on the country in which you were, was basically what we would call a consolidation phase. There was a lot of hectic activity in terms of people thinking about markets, writing about markets, a lot of prognosis in terms of how growth would come back or not come back. And there was generally a lot of drama in terms of policy making and in terms of policy expectations. But basically what happened was that the market went nowhere. For that period of time, which as I said was 3 to 6 months, depending in terms of where you were, the market fundamentally went nowhere, right? And all the drama at the end of the day, if you had slept through it, nothing would have changed, right? And the third phase, which came through beyond that, was what we would call the reflation phase, when the market started moving up consistently and the economy followed only, but much later, right? So if you were to look at that crisis, you had a capitulation stage, you had a consolidation stage, and you had a reflation stage. In my view, I think the capitulation stage we are actually done with. We have now got on to the consolidation phase, where you'll end up getting markets move plus minus 5%. But this is going to be long. As I said, last time it was 3 to 6 months. My own sense this time around is that it could potentially be a little longer, right? And it's only post this where there is much greater visibility in terms of what the trajectory of the economy is going to be, that you will actually end up seeing markets end up doing very well or potentially badly also if there is a prognosis that things are actually only going to go down, right? So I think that's the second point, that if you were to take that benchmark of the GFC, you have capitulation, you have consolidation, and you have reflation. And at this point in time, I think we have entered the consolidation phase, and it's going to be like this for a period of time, right? I think the third thing to look at is to distinguish clearly between the short term and between the long term, right? And I say this because if you were to go back to any crisis, whether it was the 2000 dot-com bubble or the GFC, right? While a lot of our eyes are focused on what's happening in the short term, so that could be earnings, that could be dislocations, that could be, when is production starting, right? The reality is the bigger trends that you actually have to catch are the longer term trends, right? Which really make a big difference. And I'll tell you why this is very material, right? And it's not as if people are not thinking like this, not an original idea, because there is a lot of talk about longer term trends. But you go back to the 2000 dot-com bubble, right? Now everyone calls it as the dot-com bubble because the markets imploded. They came off and a lot of people lost a lot of money and a lot of companies actually went bust. But you know, the reality of that is that actually that dot-com bubble, it was not a bubble. That phase of 95 to 2000 actually created some of the greatest companies that you have today, right? Whether it is Google, whether it is Amazon, whether it is Apple, whether it is any whether it is Facebook, all these guys were part of that so-called bubble. But 20 years on, these are the companies that dominate the world, right? And if everyone had interpreted the problem as, boss, all these tech companies are all, basically bubbles or overstated in terms of the change that they are making, the reality is it's completely wrong. That was the creation of the biggest and best companies that actually happened. Maybe there were hundreds of companies that died at that point in time, but what came out of that has not only prospered dramatically as businesses, right? But they've also provided huge value as far as investors are concerned, right? So if you were to go back to what happened in 2000, you had the creation of great companies, and the guys who made that were the people who looked at it and said, guys, this is where the long-term opportunities are, right? So I think even in this crisis, you've got to differentiate between what's happening now, which is lockdowns, pandemic direction, earnings hits, with the longer term, which is, are there businesses that get fundamentally valued better, right? Either because their own position strength or because their own business goes up, or because their competition tends to go down. And likewise, some of the biggest longer term trends that you need to think about are trends that diminish, this whole concept of work from home and stuff like that. Someone has to make a call that, 20 years on, 90% of working will be from home. And so then you really have to think of businesses that you shouldn't be in because this tends to happen. So I think that's very, very critical, that you break up between the short term and the long term and spend a fair amount of time thinking about the long term. The fourth thing that I would want to touch on is in the transition, and this is more near to medium term, is that when you have such a painful event, people are losing across the board. The government is losing, businesses are losing, and individuals are losing, right? A lot of these costs are taken directly. The government will have a fiscal deficit. Businesses will see dropped profitability, dropped market capitalization. Individuals will potentially see lower incomes and lower net worths and lower values, right? That's one part of it. I think the bigger thing to think about is, can someone end up sitting with disproportionate costs in this whole process? When everyone is stressed for money, is there someone who might have to take greater pain, right? Which is what I call the socialism of costs. Could some of the costs that sit with governments be socialized or pushed onto businesses? Could costs that sit with individuals to protect them be pushed onto to businesses? Or could costs be pushed across any of these, other than the fact that the government is the one who's going to be pushing out costs because its own costs are going to be very high? I think this is an important theme. This can happen in many ways. It can happen with the banks having to take extra NPLs, the banks having to fund businesses that have a challenge. It can be with pricing caps that come in. It could be, you're seeing some of this in terms of hospitals, where there are pricing caps that have come in and they've lost a lot of business. You could have situations where things like telecom can have potential pricing caps. You can have pricing caps as far as airlines are concerned. So these are a range of things that could effectively play through, which you need to be watchful about. The fifth point that I would want to think about in terms of markets and the potential trajectory, and in terms of the market trajectory, is how is risk aversion, what has happened with risk appetite in the system, and how is it going to come back, and what is going to be its path? I think this is very, very critical, because in many senses, getting out of a crisis, you need that risk appetite, the confidence to go out and spend money, invest money, and buy assets, right? I think at this point in time, India is a little bit more challenged than the rest of the world, because leading into this COVID crisis, you have already had a period of time when growth has been low, markets have generally been weak, and there have been risk issues in the market. So I think this whole issue of risk appetite is something that is material. We need to think about it hard. And in my view, that risk appetite in the system is a little lower. So to that extent, the revival, both in the economy and therefore potentially in the markets too could well be a little lower and a little slower than what you see in the rest of the system. The sixth point is, does the market get smaller? Does it get dominated by fewer businesses which are larger? Does that start reflecting through as far as market caps are concerned and as far as market valuations are concerned? I think we've seen some of this happen with Demon. I think at this point in time, it is a risk that you're sitting on where the market gets more split. A few businesses tend to get a disproportionate share of business because they are more efficient or they have larger scale. And theoretically, therefore, they get higher market capitalizations also. And quite honestly, I don't see anything happening at this point in time that could reverse this trend in a major manner. I think the final point I would want to make in terms of the landscape that we have today is, the markets have gone down, people have lost money. Is this a point in time where you're seeing opportunities or you're seeing risks or you're seeing a combination of two? And my view is, I think this event is such a landmark event that there will be material change. I think you will both have opportunities, but also have risks that go with it, which basically means you have to be very watchful in how you invest, where you invest, and you've got to think through that investment beyond the prism only in terms of valuations or that there's pent-up demand for 2 quarters that it will look very good, right? Or that its earnings are so bad and so I want to stay out of it. I think you'll see opportunities, you'll see risks. The shorter term element will be a small part of it. Your longer term extrapolation of it will be a bigger part of it. And that's what you've got to focus on. And finally, before I hand it over to Kapil, and I know I've kept him waiting a little bit, in terms of from a market perspective, what is our stance? Our stance simply is a fairly neutral one at this point in time. As I mentioned earlier, I think it's a consolidation phase that we are sitting in. The markets will potentially move up plus minus 5%, not move up very dramatically, not move down very dramatically. So to that extent, I don't think there is any hurry in terms of people saying this is an opportunity that's going to run away or this is a risk that's going to implode. I think some of those mispricings have already played through quickly. Now you have to marry the nearer term, price, the nearer term perspective, but most importantly, you have to marry it with your expectation of the landscape, and you have to marry it with your expectation of how this business will do in terms of the long term, and you have to juxtapose it with how you see the Indian economy playing out and how you see economies around the world playing out, right? So I think I've taken more than my share of time. We'll have Kapil on. Tanya will introduce him. Kapil is a star economist with very, very strong views and very differentiated views, both in terms of the Indian economy, but also and equally importantly in terms of how it how it synchronizes with global events and global economies.
Thank you so much, Aditya. That was really insightful. Ladies and gentlemen, we have Mr. Kapil Gupta. Finally, we could have him on board with all the technical glitches being resolved. He's a chief economist at Edelweiss Securities. We welcome you, sir, to our show. And over to you, Kapil.
Thank you, Tanya. Thank you, Aditya. Sorry for the apologies for the delay. So what I'll do over the next few minutes is very quickly cover the economic impact of COVID. So I'll start with I'll back up a bit and comment on what was going on just before COVID. I think that's very important. Starting point is always important. So first of all, Indian economy has witnessed kind of slow growth. It has been in that phase for a while, let's say since last 3-4 years. That is primarily the result of 2 or 3 things. One, we were undertaking structural reforms, and almost always structural reforms in the near term tend to create challenges for the growth process, even though they are much wanted for the long-term growth potential. Second, the global trade was doing very badly, partly because of the trade tensions, but generally also almost all countries were seeing slowdown in exports and imports, really. So that also was hurting. And the result of these two was that economic activity was kind of weakish. But the good thing which was happening before COVID-19 is that we were able to take care of some of these challenges. I think the near-term impact of structural reforms were beginning to fade. Exports was starting to look up, very early signs of that. NPA cycle was beginning to peak, and the monetary policy side started to work a little more aggressively to support growth. So it was starting to become a constructive economic environment, although from a weak point. Now, unfortunately, COVID crisis hit this year, and obviously large part of the economy is in a lockdown right now, which obviously hampers the economic activity. What we are saying is that this year, uh, now that the lockdown has gone on for more than a month, we are, I mean, the real economic activity could slip to 0% kind of a growth rate, or maybe modestly negative as well in FY21. Nominal GDP would also mostly slow down. The sectors uh, which attract migration from the rural to the urban areas like SME and real estate, they are also seeing the pain, and to that extent, there would be reverse migration while we speak back to the rural areas, suppressing the rural wages. So there is a near-term aggregate demand problem, and of course, uh, how eventually lockdowns will get lifted. Some parts of the economy will bounce back very quickly. Some of the other parts would take time. For example, discretionary spending and so on and so forth, travel, tourism, those kind of things will lag. Certain things will start early. But most importantly, what will matter here is what kind of policy response we take right now while we are in lockdown and once we open up, which will shape the recovery on the other side of this. And there I just make a couple of comments on the policy responses so far. So we have seen RBI doing several measures over the last 3-4 weeks. RBI is providing liquidity to the commercial banking system as much as possible so that the commercial banking system can in turn, um, take credit risk and provide liquidity or distribute that liquidity to the wider space, both in the credit markets but also in the real economy. And government measures so far are majorly focused on taking care of the humanitarian needs of food, which obviously the first things first. Now, so this is clearly the stage one of the policy response. If you map it with the global policy response, I think that's how the response shaped up. The initial response was basically trying to provide as much liquidity to the system. I think where we need to go from here is also very, very critical. If you just map what G7 countries globally have done in the stage two, is that they had started to move from providing liquidity to actually starting to take credit risk, which is to say that a lot of this liquidity which are being provided by the central banks around the world, it was hoped that this will be taken up by the commercial banks and distributed into wider system, but somehow commercial banks are extremely risk averse. Markets are extremely risk averse. It's only the large AAA corporates or the sovereigns which are getting money. But as you go down the chain, liquidity is becoming difficult. So where we need to go, and perhaps government is thinking on those lines, is that some amount of sovereign guarantee to some of these loans may be on the cards, which I think is the right step to take at this level. Maybe RBI steps up over the next few weeks to absorb a lot of this government borrowing also, because remember, government tax revenues are faltering. So to that extent, fiscal deficit numbers will look big. There will be a lot of treasury supply in the market, and a large part of it has to be absorbed by the RBI. So a coordination between a fiscal and monetary policy is the need of the hour. Timeliness is important, scale is important, and coordination is important. So if we move quickly to the stage two, where government starts to ring fence some of these loans and starts to make sure that there is not too much reverse migration or firing of jobs or so on and so forth, then once we get to the other side of it, I think recovery can be more respectable than otherwise. One question I want to cover up front, which keeps coming, is crude oil prices, of course, have fallen significantly, and on the face of it, it is a significant tailwind to India from inflation standpoint and so on and so forth. So this gives more room to the policymakers. But what also get missed out in the debate is that when oil falls, there is also liabilities which come along with it. In terms of, for example, almost always when crude oil fall sharply, the prices, we also see global demand slowing down significantly, and therefore India's exports also take a hit. And remember, India's manufacturing exports is roughly 3 times the size of the oil imports. So what we gain on oil import bill, because oil prices have come off, we tend to lose a lot of it on the export side as well. So it is not an unmitigated blessing is what my point is. And sometimes what also happens is that when crude oil prices are falling, generally the risk aversion in the market is high, and India's capital flows also dry up. So it's a mixed blessing, I would say. But fiscal policy cannot just rely on oil tailwind. I think there is a need to actually ramp up cash transfers and take credit guarantees in order to ring fence the problems over the coming few weeks. So I'll just stop here and more than happy to take questions, really.
Thank you, guys. This was indeed insightful, and I open the floor for questions now. I see some interesting questions that have already come up. The first question is for Aditya. Which sectors or businesses may be benefited by a long-term opportunity due to ongoing crisis?
Okay, very simplistically, I think there are three sectors that benefit structurally from a long term. The first, I think, is IT services. I think the shift, the fact that we are doing events like this one, just indicative of the fact that globally there is going to be a much more accelerated shift to IT. And remember, it's not only about the Microsofts and about the Zooms who benefit from this. This kind of tech spending is only 15%. The high-end tech companies. The rest of the supportive system is 85% of the global tech spend. So I think the IT space is structurally going to get a significant leg up. I think pharmaceuticals in their entirety will again actually get a leg up. It's a little bit more convoluted because pricing can be different, local regulations come into play, but I just do believe that globally there's going to be much more investment as far as pharmaceuticals are concerned, and so Indian companies should fundamentally be better positioned. And the third thing I think is telecom. All of us have lived our lives basically working on Wi-Fi and on cell phones, and I don't think that is coming back. This is a sector that's already very consolidated in India and globally, and while they might not have unmitigated pricing power, the reality is it is actually proved, data has in this crisis proved to be the new oil. It's interesting, telecom stocks have gone up and oil has gone down. It's because telecom has probably become the new oil. So these three are sectors, I think, to me, that stand out upfront very, very clear.
Thank you so much, Aditya. And here is yet another interesting question for Kapil. With all the major economies focusing now, do you think this will in some way impact inflation?
Yeah, thanks for the question. I think if you compare it with last 10 years, last 10 years, the world is facing a problem in which the global central banks are struggling to meet their inflation targets. Inflation has been consistently undershooting for last 10 years for most of the central banks, and that has been a problem. They're stuck at zero interest rates. Trying to lift inflation has not been possible. And this is despite they have lifted their balance sheets 4 times, 5 times in large parts of the world. What we are seeing right now is that the battle which central banks were fighting alone, which is Fed or ECB or others, was trying to fight this battle of lifting demand globally and lifting inflation to some extent, is now joined hands with fiscal policy as well. And remember what's happening in G7 response is not just the central banks who are at the forefront alone, they are very much in coordination with the fiscal authorities. So that gives a lot of space that central bank is providing liquidity, and then there is an entity, governments, that is, who is spending also. So I particularly feel that once we are firmly on the other side of this COVID crisis, when we are again comfortable being part of crowds and stuff like that, I feel that inflation outcomes will be relatively better. Now, not to suggest that there is a runaway inflation risk on the other side of it. I don't think so. Just that we'll move from outright deflation / disinflation tendencies in the economy to more like a much needed modest inflation around the world, which I think is a good thing for asset prices.
Thank you so much, Kapil. Aditya, I have the next question for you. There's somebody who's asked a very interesting question. How has the Federal Open Market Committee meeting impacted the market trends, and which sectors should one focus on?
Okay, this is uh, and I'm sure a couple will be able to back me up on this. But basically, the FOMC has taken a very clear-minded approach that this is a huge economic problem, and we are going to step in very aggressively. We are going to step in with liquidity. We are going to step in with credit risk. We are going to step in even as the fiscal is being stimulated, and basically you need to protect the downside, and there is no stopping that. So I think the fact that India's market is up almost 20% from its lows, the fact that the US market today, if you actually look at the US market, it's basically more or less back to where it was about a year ago, right? So many issues have happened, but the market is actually it has lost only a year's gains, and it's back at its level the previous year. So I think the Fed's meetings, the Fed's approach, which has actually filtered down to almost all central banks, not so much to ours, has really been a dominant theme in getting the markets back to where they are, and they are a big influence in terms of how the rest of global monetary policy follows.
Thank you, Aditya.
Yeah, maybe Kapil could supplement me on this.
I think pretty much what Aditya mentioned. I think fundamentally, we are in a system where dollar happens to be the reserve currency, which means all goods traded in the global economy are denominated in dollars. So everybody needs dollars. Many people borrow in dollars, so everybody needs dollars. And in these times of crisis, everybody hoards dollars. So there's only one entity who can supply dollar pretty much in unlimited quantities, which is Federal Reserve. So, I mean, it stands to reason, it stands to historical analysis that periods where dollar is strengthening, very few asset classes can perform in that period. Whereas years and decades where dollar is actually in the bear market, those are one of the best years for equity markets globally, whether emerging markets or otherwise as well, for commodities, for equities, for even emerging market bonds and so on and so forth. So, I mean, this stands out in data very unambiguously that periods of dollar strength are extremely painful, particularly for emerging market assets, whether equities or debt. Right. And so that's what precisely Fed is trying to do. Fed is trying to rein in dollar and try to weaken it so that global liquidity improves and economic damage is limited.
Thank you so much, Aditya and Kapil. With that, I guess there's another question that is for Kapil. Is it possible for the GDP to go negative given that 45% of GDP is not operating from the last 1.5 months?
Yes, I think that remains a distinct possibility, frankly. If you do a little bit of math, I think it doesn't take much actually to go to 0% growth rates. It can go into negative territory also depending on the lockdowns. And it's not that lockdowns are going to get lifted in one shot, they'll be staggered. And it's not that once it is lifted, people will be back to their normal ways very quickly. So there will be some sort of time lag before people get back to their normal ways, and therefore to that extent it is a possibility that economic activity or growth rate moves into negative territory in F21.
Thank you so much, Kapil. The next question is for Aditya. Is it true that businesses globally will actually shift to India and other Asian countries from China? If yes, which sectors will benefit from them?
Okay, I think what is true is that people will either shift out of China, parts of their businesses might shift out of China, or they might reduce their reliance on China, right? So I think that to me is unambiguous. It is both risk mitigation for such businesses. It is almost a policy initiative that some of these governments are following, and you've seen that with the US and you've seen that with Japan. And so to some extent, the fact that that stuff will move out of China is an inevitability. The issue of whether it will come to India or not, I think is a little bit more mixed, right? Because if you're a US corporation and you had this problem in China, how do you de-risk yourself? You can de-risk yourself by going to India, right? So that's a geographical diversification. But you can de-risk yourself even further by bringing it home, right? And I'd like to point this out to people that actually in this whole experience over the last month and a half, economic activity in India has been more disrupted than economic activity in China. China, only Wuhan has been shut down for 56 days. The rest of the country had some kinds of shutdowns, but India has had a 42-day shutdown across the board, right? So I would tend to believe the natural thing for a lot of businesses would be at least to get a part of their businesses back home, right? Rather than necessarily take it out of China and put it into India or Vietnam. Some of that could happen, but I think the bigger shift will be actually businesses coming home or moving to an entirely different geography. So I think that's one bit. In terms of the sector that you mentioned that could benefit if this were to happen, I think the specialty chemicals is a space I think that will benefit immensely from this. I think the pharmaceutical space will benefit from this, even as Indian companies need to de-risk themselves from actually getting a lot of their sourcing from China. And I think these two would actually stand out. For the rest, it's not going to be as easy or as much of an opportunity that I think the market is making it out to be. I think people will have to go out and grab these. They have to push very, very aggressively. But if one believes that this business will fall into India's laps, I think it will be the exception rather than the rule.
Thank you so much, Aditya. Next question for Kapil. What should be the role of RBI going forward?
So RBI has an important role to play in this at 2-3 levels. One, I think RBI, of course, needs to cut interest rates. That's bare minimum. Yeah, it brings down the borrowing cost for the government of India. Second, RBI needs to actually support the debt market, primarily GSEC, both for the state governments and the central government, because the borrowing calendar is going to be quite heavy than it was budgeted. So RBI will have to intervene heavily to absorb a lot of this treasury supply or the government bond supply. Third, RBI should also need to think about running some sort of direct lending one way or the other to NBFCs, or taking corporate bond as repo in repo financing, and so on and so forth. So I think it has to enlarge its ambit of counterparties in one way or the other, because as I mentioned earlier, the system which typically functions very well, where that commercial banks deal with RBI, and then commercial banks actually use their balance sheets and take credit risk and distribute that funding to the wider economy, that channel is not working adequately in this kind of crisis. And that's the learning from the G7 also, going direct in some form or the other. So I think these are the 3-4 things RBI must do, and I think hopefully they'll do in the coming weeks.
Thank you so much, Kapil. The next question is for Aditya. In fact, it's a long one. This crisis is entirely different compared to 1930, 2000, 2008, but COVID-19 turmoil is entirely different. Even much of financial stimulus isn't helping much to revive cause on longevity issue prevailing. Do you think any existing eco model situation will help it revive, or should a new thought process come up in economic study?
Aditya, are you on mute?
Yeah, sorry. Sorry, guys, did you get any bit of that? I think I'd gone on to mute by some mistake. Hello?
Aditya, you are audible now.
You're audible, right? No, did anyone catch any part of my answer or no?
No, I think you should repeat it, I think.
Okay. Okay, just sorry, I believe I was on mute, so I think people have not got the response. I'll just go over it again. So firstly, this is a very different crisis, and that's why I don't think templates of the past are going to be the exact templates that are required. And that is also why a lot of central banks and governments have taken very extreme measures to try and protect the downside, because this is unprecedented. The scale is very, very significant. And there isn't, as I said, a template to fall back on. I think that's the first element of it. I think the second element, which I had mentioned earlier in my conversation, was this: like any such dislocation will throw up both opportunities and will throw up risks, right? And I think that's what you need to play for. Look both in terms of what could get destroyed in the near term, what could get some business in the near term, but just longer term, what is going to entrench itself much more aggressively, right? And the third thing is, what are going to be the benchmarks when things start coming back? Is it going to be pure policy? No, I think the backdrop of this is the sooner economic activity comes back to life, you and I start going to our offices, people start constructing, people start going out and spending a little bit. I think that is going to be the basis in terms of how the recovery happens and how life gets back to normal. The variables will be what it requires from a policy perspective to get to that stage, firstly. And that's why, the general approach which the developed markets have taken is take more of a risk at this point in time rather than wait for it. I think that's the right approach, because what can effectively happen is you've dug a hole, right? The longer you wait to restart, the deeper that hole is going to become, right? And so whether it is by taking risk and going back to work, or by more policy measures, or by a combination of both, I think that's what's going to get the economy back. It's going to be humming. It doesn't matter whether it's 2% growth or minus 2% growth. You just have to have an active economy. The day that starts, then you start making longer calls in terms of what will come back, what will not come back. I know it's almost it's more a convoluted answer than your question, but I hope that's reasonably satisfactory.
Thank you so much, Aditya, but we are also keen to know Kapil's view on the same.
Yeah, I think yes. It's quite a unique crisis, frankly speaking, because here, remember, in every crisis, the role of the government is actually to support the economy by, let's say, if private sector is not borrowing and spending on its own for whatever reasons, government of the day take kind of offsets that slowdown by borrowing and spending in its own books, right? Now the problem with this is that here the government role, and perhaps rightly so, is to actually lock down the economy, right? So government is not the entity who can stimulate at this point of time, because you can't stimulate and lock down the economy at the same time. Where the role of the government will move back into traditional space is that once the lockdowns get over, governments will have to come with spending programs and tax cuts and some of the stimulus programs so that the economic recovery can be aided, right? So on this side of COVID-19, the role of the government is actually to put the economy in the lockdown, but at the same time try to cover as much ground as possible in preventing debt defaults and layoffs. And once we get to the other side, government need to get into spending mode really. So I think that's what the role of the government is, just changes a little bit compared to the other crises.
Thank you so much, gentlemen, for your insights. Would you like to share some closing remarks with the audience?
All we'd like to say is thank you. I know there's a lot of information that's floating around. I hope we've been more specific in terms of addressing what we think are the critical elements that you need to look out for. What are the measures that could bring this economy back on track? Thank you for listening, and all the best. And if you have more queries for either of us, just to write in.
Thank you very much to everybody.
Thank you, Aditya and Kapil. It was an immense pleasure to have you on board. Your thoughts and insights on the current market landscape was extremely useful. I'm sure that our audience found your expertise of significant value and they will gain from this experience. To our audience, thank you so much for tuning in. We look forward to having you join us back on the 2nd of May. Till then, stay home, stay safe, and stay calm.